The most dangerous lease in your entire portfolio is likely the one that you have with yourself. If you own one of your clinic buildings in a separate LLC, you know, your operating company paying rent to your property company, that rent was probably set by your accountant to cover debt service, to optimize taxes, to move the money where you wanted it. And you know what? It was probably rational. But unfortunately, what no one does is underwrite the lease like an institutional buyer would. Because the first thing a quality of earning teams does when they find a related party lease is throw that rent number out and replace it with their own. I've spent my career on both sides of these transactions, developing facilities for the operators, as well as negotiating alongside the capital that buys them. And I can tell you that the rent you charge yourself is not a number that buyers will accept. It is a number that they will negotiate. Today, we go over what that correction does to your enterprise value. Why the damage isn't actually a loss, it's really a transfer of value that you're failing to capture. And the version of this problem where you discover you own income you literally cannot sell. Let's be precise about the structure, because the structure is not the problem. Sophisticated operators, they separate their operating company from the real estate for a really good reason. There's plenty. You may just want to build wealth outside of the operating company. You want to limit your liabilities. You just want to move wealth from the operating company to your family or family office. There's tax efficiencies. There's many different reasons. So by no means am I saying don't do that. There's several reasons, to structure it that way. So if you've done this, good. That's what good operators do. But here's the problem. The lease between your OpCo and your PropCo, well, it's the least negotiated lease in your entire company. No landlord pushing escalators, no tenant rep pushing back on term. The landlord isn't stress testing the debt coverage, which means the lease, well, it was never really priced by the market. And documents that weren't priced by the market, well, they typically don't survive contact with one. And that contact likely happens on the two most important days in your business life. The day you sell your business or platform, or the day you sell or refinance your building. Both sides of that could get repriced, and let me show you exactly how. So here's the scenario. You have 8 locations in the platform, you've leased 7, and you own 1. It's the flagship location, it's 8,000 square feet in a fantastic area. You leased it to yourself several years ago when you started this journey. Let's say you leased it at $12 a foot. So that's $96,000 a year in rent that you pay your PropCo. Today, market rent in that trade area for comparable medical office is $32 a foot. That is $256,000 annually in rent payments. Now, of course, those numbers will vary based on the product type and the market, but the mechanics won't. Your P&L is showing $160,000 below market in rent, so $160,000 less than what you would be paying a third party in that same market, and that will show up. Now your platform goes to market, and a buyer, they send you an LOI at 9 times adjusted EBITDA. Let's call it a mid-market healthcare platform, depending on scale, the payer mix, and growth. They could trade anywhere between a 7 and a 12 multiple. And their quality of earning teams open your books, and the first thing they find in 4 minutes is a related party lease. It's pretty much the first thing they're gonna look for. They don't negotiate your rent number, they replace it, and they adjust EBITDA down $160,000. At a 9 multiple, that's about $1.44 million off your enterprise value. Not at a negotiation table, but in a spreadsheet after you've lost your leverage. And you didn't lose the negotiation. What you lost was the underwriting. And look, let's understand why they do it, because this is not extraction. The buyer's lender cannot size debt against an occupancy cost that evaporates the day you leave. Nor can their investment committee underwrite a P&L that subsidized a seller's tax strategy. The day after close, that business is gonna pay market rent to somebody. The quality of earning team isn't punishing you. They're pricing reality, but it's your job to price it first. Now here's an important part that we can't miss. The $160,000 didn't evaporate, it just moved. Every dollar of rent that the team moves to your OpCo's expenses lands on the other side of the wall, into the net operating income of your PropCo. Now let's run the other side of that math. $256,000 in annual rent papered on institutional grade lease, and we'll spec that out later, on a 6 cap is roughly $4.26 million. Healthcare net lease trades anywhere between 5.5 to 6.5 cap rates in today's market, just depending on structure, credit, lease terms. The same range institutional buyers underwrite when they purchase these type of assets. But here's the catch, and it may be the most important part of the whole video. The transfer only occurs if the lease is real. They're paying market rents, arm's length terms, and signed and seasoned well before the process starts. Do that and the value shows up twice. A clean EBITDA on the operating side and a financeable, sellable asset on the PropCo side. Skip it and you get the worst of both worlds. A quality of earnings haircut on your multiple, and a building lease that no appraiser, no lender, and no net lease buyer will underwrite at face value. The value fell in the gap between your two entities and absolutely nobody can pick it up. Hey, look, if you own any of your real estate in a separate entity, go and pull your leases this week, if there even is one, and ask yourself two questions. Is the rent a market number that would survive a third-party rent study? And does the paper pass institutional underwriting? If you're not sure, that's exactly what I do with operators. Book a strategy session. The link is in the description. There's a version of this problem actually that is worse than charging yourself too little. And it's charging yourself too much only to find out that you own income that you can't sell. There's plenty of operators that run this the other way. Rent set high, say $300,000 in a 220 market. Because the building, well, it's the retirement plan. And let's face it, as rent's a tax favorable way to pull cash out of the practice and into your pocket. I get the logic, but let's see what happens on both sides of the wall. Side one is your platform. Your EBITDA is understated by $80,000. Yes, a quality of earnings team can normalize upwards, but now you're the one asking for an add back. And buyers scrutinize seller favorable adjustments far harder than they scrutinize seller unfavorable adjustments. Now you've spent real negotiating capital defending your own P&L. Side two is the killer. When you go to sell or refinance the building, $300,000 of NOI at a 6 cap, and you're asking $5 million for the building. And every underwriter does the exact same thing in the first hour. They see a related party tenant, they run rent comps, and they reprice it at $220. At the same cap rate, that's roughly $3.7 million. That's a $1.3 million haircut. The extra $1.3 million existed only as long as you were paying it to yourself. Here's the credit logic. Above market rent on a tenant that you control, well, that's not durable income. The day your platform sells, new ownership will renegotiate it to market. And the first time your OpCo tightens, a net lease buyer isn't buying your building. They're buying your lease. And a lease that you gave yourself above market, well, that's fiction with your signature on it. You cannot sell rent to yourself. You can only pay it. Even when the rent number is right, the paper usually isn't. I've seen related party leases, unsigned, month to month, gross instead of net lease, all kinds of things. I mean, the fact is that you were never going to evict yourself, but your buyer's lender needs what every other institutional lender needs. Real turn with options, 15 plus years of site control, the same runway math that healthcare investors underwrite when looking at healthcare assets. Predetermined escalators, not resets, the same mechanics from the 3% clause breakdown applied here. Absolute triple net and assignment language that survives a corporate transaction. Because in healthcare M&A, you better believe that this lease is going to exchange hands. And if it cannot transfer cleanly, then it becomes a silent deal killer that we've talked about before. In a platform sale, a related party lease, it's going to get rewritten at close either way. The only question is who holds the pen? You, 24 months earlier, on your terms, or the buyer's counsel, inside exclusivity, on their terms. Here's the sequence, and it starts 24 months before you ever take the call from the banker. 1, commission a third-party fair market rent study. Don't use your accountant's number. You can use a local broker that specializes in medtel or medical office, someone who knows what they're doing, and something that is defensible when the quality of earning team looks at your rent number. 2, paper the lease to institutional grade, the 4 elements that we just discussed. 3, season it. Run the business at fair market rents through at least one full tax and audit cycle, because normalized numbers with history always beats adjustments with explanations. 4, decide the PropCo strategy before the process starts. Hold as passive income alongside a buyer credit lease, or sell it alongside the platform that you just sold. You can even sell it to a net lease investor independent of you holding it or selling it to the buyer of the business. Each one prices differently, and that decision deserves its own breakdown. There's always an exception, and one exception is if you're going to the market inside 12 months, don't over-engineer this. Get the rent study, disclose the related party lease on day one, and negotiate the normalization into the LOI before exclusivity while you still have leverage. A known adjustment is just a term. A discovered adjustment is a retrade. The good news is that the sidecar structure is right. The number in it is usually wrong. In the paper, well, it most certainly is. Below market, and the quality of earnings team has repriced your platform after your leverage is gone. Above market, and you've built income that you cannot sell. Either way, the related party lease is the only lease in your portfolio where you control every single term. Most operators use that control to optimize this year's taxes. Institutional operators use that control to structure the exit. I hope that added value, and I'll see you on the next one.